Put options are often compared to insurance policies for good reason. When you buy a put, you're given the guarantee that you'll be able to sell the shares of a stock at a certain price, known as the strike price, by a certain date, known as the expiration date. If you buy a put at the $50 strike price, for example, and then the stock trades down to $45 per share, you can exercise your put and sell the shares at a guaranteed $50 per share price. But instead of buying insurance, you can be the one that sells insurance. The big advantage here is that by selling insurance policies in the form of put option contracts, you can generate good cash flow. When you buy a put option, the cash immediately comes out of your pocket. But when you sell a put, you collect the insurance premium upfront. When selling puts, we want one of two things to happen. We want the put to expire worthless, or we want for the value of the put to at least decline over time so that we can buy it back and close out the trade for less than what you originally received to sell to open the position. And a put option can lose value in three ways. The stock price rises, the passage of time, or there is a decline in implied volatility levels. Now let's look at what it means to become your own insurance company. Writing or selling puts spins off a lot of cash. I personally target 12 to 24% annualized returns on all the trades I sell options on. Most people who sell puts do it for the income, and there's nothing wrong with that. As we'll see in a moment, this is a viable choice as long as you adhere to a set of strict underwriting standards. The real advantage of us versus a traditional insurance company are twofold. We have the freedom to choose who or what we insure. And number two is that we have the unique ability to renegotiate our contract terms. Freedom to choose means you don't have to insure just anyone or anything. You can be highly selective of who you insure, when you insure them, and at what rates you insure them for. And secondly, when you insure a stock and it goes down such that Mr. Market is within his rights to file a claim, which you can define as you being forced to either buy the shares at the agreed upon insured price or buy back the put option contract for a loss, you can renegotiate the original contractual terms. Here's another example. A smashed up car is not going to repair itself. If it's covered by the policy, an insurance company has no real choice but pay out the claim. Selling puts is a very different reality. A stock can repair itself by trading higher once again. And unlike a traditional insurance company, you can renegotiate the original contract with a new contract and with better terms for yourself. You can view this method and way of thinking as you becoming a nightmare underwriter or the insurance company from hell. Either way, the objective is to collect lots of premium and never pay out a claim. And you can achieve this by renegotiating the original terms of your trade for a better outcome. For example, if you insure a stock at $100 per share, but then, as expiration nears, the stock is trading at $99, you can buy back the put option and potentially book a loss on this position. Or you can also do nothing and simply allow yourself to be assigned the shares. Either way, you are probably not coming out ahead on this trade, but you can also renegotiate your contractual obligations. You can exchange the expiring contract and replace it with one that's better for you. For example, you might be able to make a counteroffer. Instead of you insuring 100 shares of a stock at $100 per share by, say, the June expiration date, how about you instead insure the shares at $98 until the July expiration date? And also, you would like more money, a net credit, if you're going to extend your insurance policy like this. Now that's something of an oversimplification of the process, but you get the idea of how you can become a nightmare underwriter, avoid paying out claims to Mr. Market, and renegotiate a new contract by essentially rolling your strike price out in time and further down in price. That is a wrap for today's video. Please like and subscribe, and as always, dear listener, take care and happy investing.